Welcome to the Deep Dive. We cut through the noise, get you straight to the insights that matter.
Glad to be here.
Today, we're plunging into something I find genuinely fascinating. It's this mix of deep tradition and really cutting-edge innovation in finance.
Yeah, it's quite the contrast, isn't it?
It is. We're looking at how some of the oldest players, these really established institutions, aren't just, keeping pace. They're actually leading the charge in some ways.
Exactly. And today, our focus is squarely on BNY Mellon. You've shared their second quarter 2025 earnings call transcript, plus all the detailed financial supplements.
Right.
So our mission really is to pull out the key insights from these sources, understand how this giant, and they are a giant, over 240 years old, is handling market volatility, pushing through a multi-year transformation.
And what these latest results actually tell us about where finance might be heading.
Precisely.
So what you can expect from us is, well, we'll break it down, go beyond just the headlines. We'll unpack the Q2 numbers, sure.
Sure.
But I think more importantly, explore the strategy shifts.
The commercial models, the operating platforms.
Exactly. And then we get into the really interesting stuff that moves into digital assets, AI, which might surprise some people.
Definitely.
And then we'll tie it all back. What does it mean for you listening and for the wider financial world?
Sounds like a plan.
Okay, so let's set the stage first. Q2 2025. What was the environment like for BNY Mellon? Because the sources paint a picture that's, well, far from calm.
No, not calm at all. You had elevated market volatility, definitely. Record trading activity in U.S. equities.
Right.
Increased volumes in the treasury market, too. And then there's the backdrop of geopolitical tensions, ongoing conflicts, uncertainty around global trade, fiscal policy.
So a pretty challenging environment to post strong numbers in, you'd think.
You would. And that's what's striking. BNY Mellon, despite all that, showed really remarkable resilience and commercial strength.
How so? What did they point to?
Well, their leadership talked about their unique position. They see themselves as a financial services platforms company right at the heart of global capital markets.
Okay, that sounds a bit like corporate speak, but what does it actually mean in practice?
It means they sit at this crucial intersection point. And that, plus their diversified business model, allowed them to, well, not just cope with the volatility, but actually thrive.
And the numbers seem to bear that out, right?
Right.
Let's look at Q2 25 versus Q2 24.
Yeah, the performance was genuinely impressive.
Total revenue up 9% year over year. And this is a big one, exceeding $5 billion in a quarter for the first time ever.
Right, over $5 billion, that's a significant milestone.
And EPS, earnings per share.
Also strong, up 27% year over year reported, hitting $1.93. And if you exclude some notable items, it was actually up 28%.
Okay, so strong top line. But what about efficiency? Because growth is one thing, profitable growth is another.
Exactly, and that's key here. They generated significant positive operating leverage, about 500 basis points.
Right. So for you listening, that means revenue grew 9%, but expenses only grew 4%. So that's a healthy gap.
A very healthy gap. It's a powerful signal that their big transformation effort is actually improving the underlying business structure. It's not just market lift.
Makes sense.
And you see that in the margins, too. Pre-tax margin improved to 37%, and ROTCE, return on tangible common equity, climbed impressively to 28%.
28% ROTCE.
Yeah. These aren't just, good numbers. They're strong indicators of potential, reflecting real operational changes.
So it sounds like these results are, as you said, a direct output of a deliberate strategy. They describe it as simple but powerful. What was it again?
To be more for our clients by running our company better, all powered by our culture.
Simple but powerful. Okay. So what are the key pillars holding that up? How are they actually doing that?
Well, one foundational piece is their commercial model. It just hit its one-year anniversary. And this isn't just about, selling more stuff. It's designed to help clients use the whole range of BNY Mellon's platforms, moving beyond single transactions to more integrated solutions.
Making it easier for clients to tap into everything they offer?
Exactly.
And is it working?
Seems like it. They reported their second consecutive quarter of record sales, and they specifically mention growth in multi-product relationships.
Okay, give us an example. How does this look in the real world?
A good one they highlighted is their expanded relationship with Lion Trust. They're a specialist UK asset manager.
Right.
So Lion Trust was already using BNY Mellon's data vault and some middle office capabilities, but now they've fully outsourced their trading to BNY Mellon's buy-side trading team.
Fully outsourced. That's significant.
It is. It means 24-hour global trade execution across 100 markets, all handled by BNY Mellon.
Wow. Okay, so what does that tell us about BNY Mellon's approach?
It really shows they're leaning into being a solutions delivery business, not just, a collection of services. They're using their suite of highly adjacent platforms to build these powerful combined solutions.
And Lion Trust handing over global trading suggests a lot of trust in that integrated capability.
Absolutely. It simplifies things massively for the client and gives them a potential edge.
Okay, this brings us to an area that I find really fascinating, especially for such an old institution. They're talking about building the financial infrastructure of the future.
Mm-hmm. Bridging traditional and digital ecosystems.
Yeah, for a 240-year-old bank, that's a bold statement.
Yeah.
They mentioned early and continuous investments in our digital assets platform. What are we actually seeing from that?
We're seeing some very concrete, high-profile results now. Just last month, Societe Generale picked BNY Mellon as the reserve custodian for their first USD stablecoin in Europe.
Okay, big name.
And then just recently, Ripple announced BNY Mellon will be the primary custodian for their USD stablecoin reserves.
Ripple, too. So they're really planting a flag in the stablecoin space.
They are. They're positioning themselves as a leader in servicing this market, everything from issuance support to ongoing operations. It's basically taking their core business, looking after stuff, payments, and applying it to the digital world with institutional rigor.
So it's an evolution of what they already do, just for digital assets.
Exactly.
Now, beyond these big stablecoin deals, the sources also talk about a constant stream of product-level micro-innovations, smaller things happening week by week, month by month.
Yeah, things like flexible financing, global clearing enhancements, linking collateral loan into liquidity direct, FX hedge direct for private markets.
Yeah.
Even agency lending in Saudi Arabia, depository receipts in Canada.
Right, a whole list. What's the significance of these smaller steps? They don't sound as flashy as stablecoins.
Maybe not as flashy, but they're critical. They show this agile, iterative approach to growth. It's about constantly tweaking, enhancing cross-selling, finding ways to reduce the cost to serve clients.
Driving that organic growth from the ground up.
Precisely. It shows they're not just waiting for the next big thing, but constantly optimizing what they have.
And that ties into their internal structure, right? They said 2025 is a milestone year for their transition to a platformed operating model. What exactly is that for a company this size?
Yeah, it's a big shift. Think of it less like a traditional bank with separate product silos and more like a tech company with a unified digital infrastructure.
Okay.
This platform approach lets different services connect and share data much more easily. It boosts efficiency, improves the client experience across everything they offer.
And how far along are they?
They said more than half their people are already in this new model, and they're on track to finish the rollout by mid-2026.
And they're seeing results already?
Apparently so. Teams launching more solutions, faster code releases, better collaboration.
And then there's the AI piece, which is really striking. They said nearly all employees are using their AI platform, Elisa. And they've even started introducing digital employees.
Yeah, Elisa is described as a multi-agentic enterprise AI platform.
Multi-agentic, what does that mean?
It just means it's not one single AI, but lots of specialized AI agents or modules working together, learning from each other across different parts of the business.
So specific AIs for specific tasks, but they talk to each other.
Sort of, yeah. And they're quite bullish on it. They admit it's early days, but they're seeing benefits and expect it to accelerate.
And they see it helping both the top line and the bottom line.
Right. A top-line story by enabling new products and solutions, and an expense story by unlocking capacity, improving efficiency. It's a big strategic bet.
Okay, so we've got the strategy, the transformation, the tech push, but, for a bank, the numbers have to back it up. Let's dig back into those Q2 financials compared to last year. Fee revenue.
Fee revenue was up 7% overall. Investment services fees specifically up a strong 9%.
And assets, AUCA and AUM.
Assets under custody and/or administration, AUCA, hit $55.8 trillion. That's up 13% year over year.
$55.8 trillion.
Huge number, driven by client inflows, higher market values, and also a weaker U.S. dollar helped a bit. Assets under management, AUM, were $2.1 trillion, up 3%.
Okay, only 3% on AUM. Any reason?
They did note $17 billion in net outflows during the quarter, mostly from index, multi-asset, and equity strategies, but that was partly offset by inflows into cash and fixed income. So a bit of a mixed picture there within AUM.
Got it. What about FX and net interest income?
Foreign exchange revenue was strong, up 16%, shows they navigated the volatility well. And net interest income, NII, came in at $1.2 billion, up a healthy 17% year over year.
What drove the NII increase?
Mainly reinvesting maturing securities at higher yields, plus some balance sheet growth.
And expenses. We know they grew slower than revenue.
Right. Non-interest expense was up 4%, hitting $3.2 billion, so controlled growth there.
Okay, let's talk capital and liquidity. How are they looking on that front, especially after the stress tests?
Very solid. The 2025 stress test affirmed their resilience. Their stress capital buffer stayed unchanged at the regulatory floor, 2.5%.
Which is basically the minimum required, so it's a good sign.
It's a strong vote of confidence. And they're returning capital aggressively, returned $1.2 billion to shareholders in the first half of the year. That's a 92% total payout ratio year to date.
How did they do that?
Through a 13% hike in their quarterly dividend, plus share buybacks.
And key ratios. CET1, liquidity.
CET1 ratio held steady at 11.5%. Liquidity coverage ratio, LCR, at 112%. Net stable funding ratio, NSFR, at 131%.
So all well above the minimums. For you listening, these ratios, CET1, LCR, NSFR, they aren't just regulatory hoops. For a bank this central, they signal a deep well of financial strength, reassuring everyone they can handle serious market stress.
Absolutely. Strong foundation.
Okay, what about looking ahead? Do they update their outlook for the rest of 2025?
They did. They nudged up their expectation for full-year net interest income, now expecting it to be up high single digits year over year.
Okay, better NII outlook.
Fee revenue, they still expect solid growth, but they always add the caveat, market dependent.
Yeah.
Expenses, excluding notable items, they now see up about 3% year over year. So slightly tighter control than the Q2 number implied for the full year.
3% expense growth.
Okay. Tax rate still expected around 22-23%, and capital returns still planning to return roughly 100% plus or minus of 2025 earnings via dividends and buybacks.
So broadly consistent, slightly better NII, slightly tighter expense control.
That's the picture.
Okay, this brings us to the bigger strategic questions, particularly around how they use that capital. There's always this debate. Buybacks versus M&A, especially with rumors sometimes swirling.
Yeah, that always comes up.
They seem to be emphasizing the significant runway on all things organic. How seriously should we take that? Are they ruling out deals?
Their messaging is very clear. The primary focus is organic growth. They kept repeating that it's working, and they're just at the beginning of a multi-year journey. And remember, it's a capital-light business. That 28% ROTCE reflects that. They don't need huge deals to generate returns in the same way some other banks might.
So what about M&A then? Off the table?
Not off the table, but they set a very high bar, especially for anything large. It would have to make a ton of sense. They'd need a lot of conviction around execution, a strong cultural fit, and crucially, the financials really have to work.
So highly selective.
Very selective. They seem much more comfortable with smaller capability buys, like the Archer acquisition last year. They said that helped them go faster, de-risk things.
Right, versus selling off non-core bits like their Canadian corporate trust business.
Exactly. It's a two-sided story, optimizing the portfolio. And interestingly, they linked this back to the platform's operating model.
How so?
They said having that clearer internal structure, that clarity of chassis, means if they do M&A later, they can manage higher quality integrations, make them smoother, more effective.
Ah, okay. So the internal cleanup actually makes future M&A potentially easier, even if it's not the focus now.
That seems to be the implication.
So let's talk more about that organic growth then. How confident are they, really, in driving it higher, especially if investors maybe had doubts in the past?
They sound quite confident. They talked about intentionally repositioning the company to take advantage of more different types of environments.
Meaning less dependent on just market movements.
Exactly. Less handed our results by the market conditions and more in charge of our own destiny. They use the phrase many cylinders in this particular engine.
Okay, so multiple drivers of growth.
Right, and a constant focus on alpha generation, not just market beta, but actually adding value through how they run the company.
And the synergy piece seems key too. clients using multiple platforms getting better results.
Yes, like that custody, treasury clearing, collateral example. Integration enables things like 24-hour operations, makes adopting digital assets easier.
You mentioned earlier they highlighted no negative pricing this quarter. How does that fit in?
They directly linked that to their ability to reduce our cost to serve. Because they're more efficient, they don't have to compete solely on price, they can maintain value. That helps drive profitable organic growth.
Right. And they also mentioned a new product model.
Yeah, led by Carolyn Weinberg. Seems aimed at proactively identifying opportunities across the different businesses to create new combined products. Another way to leverage the platform structure.
And they also pointed to investment in wealth management as having room to grow its margin.
Correct. Currently around 19% pre-tax margin, they see upside towards 25%. That contributes to overall enterprise growth, too.
Okay, so lots of levers for organic growth.
Mm-hmm.
Which brings up a question. Given all this momentum, the strong results, the opportunities, why only guide to 3% expense growth for the year? Why not invest more aggressively?
It's a fair question, and apparently one they ask themselves internally. There's a constant push on the business units to invest, but also financial discipline. They seem wary of overcommitting to higher fixed costs, especially given the uncertain macro environment we discussed earlier.
Hedging their bets a bit?
You could say that. They stress they're not setting ceilings on growth or returns. It feels like a balanced approach, investing heavily in specific areas like digital and AI, but keeping the overall operational cost base lean and flexible.
Makes sense. Disciplined growth.
Seems to be the goal.
Okay, let's try and wrap this up then. Today, we've really unpacked how BNY Mellon's big strategic transformation, that client focus, the platform model, the investments in digital and AI, isn't just, slides in a presentation.
No, it's delivering real financial results. Positive operating leverage, strong returns. It seems to be genuinely preparing this venerable company for a pretty dynamic future.
Right. They're showing you can get that leverage and high returns while still investing strategically. Which leads to maybe a final thought to leave with you.
Okay.
BNY Mellon is managing this balancing act now. But in a world where tech keeps accelerating, geopolitical shifts keep happening. How does a 240-year-old institution maintain what they call an agile, decadal view of transformation?
While also consistently meeting or even beating the ever-increasing expectations of clients and shareholders for both constant innovation and steady return.
Exactly. How do you stay agile for the long term while delivering consistently in the short term? That seems like the ongoing challenge.
It's the perennial challenge for incumbents, definitely.
Well, we hope this deep dive gave you a fresh perspective on how one major player is navigating that intersection of tradition and innovation.
Hope it was useful.
Keep the insights coming, and we'll keep unpacking them for you right here on The Deep Dive.